Return on capital employed is an accounting ratio used in finance, valuation, and accounting. The formula, expressed as or percent, it is similar to return on assets, but one takes into account sources of financing. Net operating profit after tax is equal to EBIT. The return on the capital employed should be measured in after-tax terms. Operating income, EBIT, stands for earnings before interest and tax. Capital employed, in the denominator we have net assets or capital employed instead of total assets. Capital employed has many definitions. In general, it is the capital investment necessary for a business to function. It is commonly represented as total assets less current liabilities. ROCE uses the reported capital numbers. If one instead uses the average of the opening and closing capital for the period, one obtains return on average capital employed. Application: ROCE is used to prove the value the business gains from its assets and liabilities. A business which owns lots of land will have a smaller ROCE compared to a business which owns little land but makes the same profit. It basically can be used to show how much a business is gaining for its assets, or how much it is losing for its liabilities. Drawbacks of ROCE: the main drawback of ROCE is that it measures return against the book value of assets in the business. As these are depreciated, the ROCE will increase even though cash flow has remained the same. Thus, older businesses with depreciated assets will tend to have higher ROCE than newer, possibly better businesses. In addition, while cash flow is affected by inflation, the book value of assets is not. Consequently, revenues increase with inflation while capital employed generally does not. See also, cash flow, return on investment, return on operating capital, return on invested capital, return on equity, return on assets, economic value added, cash surplus value added index. References